Welcome to another unplanned audio-only version of the Ghost Bites podcast. I really wish that I could tell you that my website has been sorted, but now there is some or another mystical issue at the server. And so here we are back on YouTube and Spotify and Apple Podcasts, if that's where you are choosing to listen. I am terribly sorry about all of these IT issues. You can well imagine how much I'm enjoying it and what conversations are happening in the background. So I do very sincerely apologize and thank you for being here. Let me begin with African Rainbow Minerals, where they are investing heavily in two South African projects, and this is proof that mining requires just so much bravery when it comes to multi-year capex. They've approved the Bokoni Platinum Mines project, and that comes with a capex bill of 15.2 billion rand. Quite the show of faith in this mine and this metal for that matter. Of course, it's very difficult to know where PGM prices will go. So what these mines do is they do a definitive feasibility study with a best estimate of how much money they think they can make from it. And then they go off and do the project and they hope that the metal itself actually plays ball. Now, in this case, they are looking to achieve production of 180,000 tons per month. That's 60,000 tons per month from the existing concentrator and 120,000 tons per month from a new one. The refurbished existing concentrator is expected to be commissioned in the first half of the 2028 financial year, and the new concentrator in the second half of 2030. So you can see that they need to look several years ahead on projects like these. Steady state across the project is expected to be reached in 2032. Now, the expected internal rate of return on this is 28%, and although this will ultimately depend on PGM prices, that is an encouraging return at least that has some margin for error. It also helps them that the capex bill is going to be spread over 7 years, and that the refurbished concentrator will be a positive contributor to cash flows while the new concentrator is built. If you've ever run one of these NPV or IRR calculations, you'll know that the timing of the cash flows makes a really big difference. If you can spread the expense and get some income along the way, it helps a lot. Now, African Rainbow Minerals believes they can fund this project mainly with existing cash resources and profits generated over time. They talk about external debt funding, quote unquote, to the extent required, which makes it sound like they won't need much. The company has separately approved the recommencement of open pit mining and nickel concentrate production at the Nkomati nickel mine. Far more modest capex bill here, 753 million rand. Very similar IRR actually, 28.36%. Interesting to see convergence of the IRR on two projects with very different sizes and different underlying metals. Rather interesting. Unfortunately, African Rainbow Minerals is down more than 20% over 12 months and pretty close to 52-week lows. So they need to be brave, commit to the through-the-cycle investment. That is essentially how mining works. Another mining name, Anglo American, one of the most famous names of them all in mining. That doesn't mean that Anglo American has had an easy run. Far from it, actually. They've had quite a lot of difficult stuff to deal with. They've released a production report for the quarter ended June 2026, and as you're probably aware, copper remains the belle of the ball in the mining sector. Anglo is expecting their copper-driven merger with Teck to be completed by March 2027, and this is very much the commodity that everyone is watching. Now, they did increase their copper production at two of their major mines on a quarter-on-quarter basis, so that's at least something positive. They also restarted the second plant at another mine, and that was, again, good news for copper. But if you look year-on-year, copper production perfectly flat. Guidance for 2026 is unchanged and weighted towards the second half, so quite a lot of execution risk here. They're going to need to have a really strong second half to the year if they're going to hit their guidance. It's always better if you're actually banked a lot of it already at the halfway mark, as opposed to talking about production that is weighted towards the second half. Then in iron ore, and we'll deal with this later, but they describe Kumba as a stable performance. Probably not an unfair take given the performance there. I think that's reasonable. Same language applied to Minas Rio. Although premium ore production increased by 1% quarter on quarter at Anglo, that's across Kumba and Minas Rio, the year-on-year number is a decrease of 3%. Production guidance unchanged for the year, while sales at Kumba will depend significantly on what happens at Transnet. In manganese ore, production was up 20% quarter-on-quarter, 22% year-on-year. Previous year was a soft base because of the knock-on effects of the tropical cyclone in March 2024. It shows you how long those impacts last for. And then that takes us to the end of the commodities that Anglo actually wants to keep. We now move into the businesses they are getting out of as part of their broader corporate simplification. So in May, they agreed to sell their steelmaking coal business in Australia for up to almost $3.9 billion in cash. They expect it to complete by the first quarter of 2027. Steelmaking coal production was up 32% quarter on quarter, but down 1% year on year. So lots of volatility there. Then De Beers. This is always the interesting one, right? Because I've always enjoyed writing about lab-grown diamonds disruption. I was right about that, and it just seems to be going from bad to worse for them. It's really, really rough when you see stuff like diamond prices down 32% year on year for the first half. It's horrible. Production way up 88% year on year, 9% quarter on quarter. They talk about the timing of maintenance and the grade of ore being mined, but the reality is that, maybe diamonds are not so rare when you're seeing production come up like this. And I think it's because of pricing. They just have no choice now. When your prices come down like that, you can't stay in business unless you ramp up your volumes. Now, they are looking to sell De Beers. At the moment, from news headlines I've seen, a consortium led by Gareth Penny, an ex-CEO of De Beers, appears to be the front runner. We'll wait for formal confirmation of that. I can only laugh at the fact that we might see De Beers bought by a penny. That's nominative determinism of the highest order here, because pennies are exactly what I think Anglo will get for that asset. It really has been a remarkable story. And then finally, the nickel business. Anglo has agreed to sell that to MMG Singapore Resources. The deal is currently going through European competition approval processes. Production was down quarter on quarter by 4% and 6% year on year. So it doesn't seem like the end of the world there, and hopefully they do get that deal across the line. Until the deals are actually done, you do have to look at these production numbers, because obviously Anglo could still end up being stuck with these assets. We can't just sweep them under the carpet and hope that they'll go away. I'll deal immediately then with Kumba, which is ultimately part of the Anglo Group, although it's separately listed. Kumba released a production and sales report for the 6 months to June. Production down 3% year on year thanks to a 16% drop at Kolomela. Session is a much larger mine, and a 3% increase at that mine still wasn't enough to offset that downward pressure at Kolomela, so that's a problem. This directly impacts the level of on-mine stock, which is down quite significantly from 5.7 million tons in December 2025 to 4.8 million tons at the end of June 2026. So that's the production story. Sales volumes down 1% in a period that included planned maintenance by Transnet. Kumba did at least do their maintenance at their own mines at the same time as the Transnet shutdown, so they are trying to mitigate that impact. Stock held at the Saldanha Bay port has increased from 1.8 million tons to 2.2 million tons. And again, that's just because it's actually quite hard to get the stuff out the door. Anyone who's followed this sector for a long time will know that Transnet does tend to be a sticking point. But despite the pressure in H1, the company feels good about delivering full year production and sales guidance. Tells you quite a lot about the resilience they bake into their guidance. This company has been bruised many, many times. Cost guidance has been left unchanged for both Sishen and Kolomela, but they have noted upward inflationary pressures and highlighted that they could well end up sort of middle to upper end of the ranges here. Separately, they announced a 20-year energy offtake agreement with Envusa Energy for the on-site supply of electricity to Sishen. This will take their renewable energy penetration to around 45% along with existing projects, so that's lovely to see. Obviously, this has gone a long way towards improving the overall electricity story in South Africa, where pressure has been taken off Eskom through projects like these. Tough business to run, Kumba. Share price, or rather its total return, is minus 6% over 12 months, minus 26% over 3 years, and minus 36% over 5 years. None of that is pretty. All of that is bright red. Tough business. Then we skip across to Fairvest for something completely different. This is a property company that actually has a significant investment in a fibre business, not something you'll read about every day. Fairvest is more than just a traditional property company, clearly. They have an unusual investment in the form of One Path Investments, which is a fibre infrastructure company. To help the market understand more about it, they delivered an investor presentation focusing exclusively on One Path. Now, the way this works is One Path is basically the landlord in this situation. Fibre Time is the tenant, and Fibre Time's model is based on a cost of around R5 per day and a pay-as-you-go model to give township residents access to fibre at an affordable rate. And it seems to work, because in FY25 they had 285,000 users. By FY27 they reckon they'll have over 3 million users. And by FY30, 20 million users. How's that for growth? So, very interesting. That's a good tenant for them to have. And then there's another company running around in the system called Refiber Digital Infrastructure that acts as the capital and asset manager. So essentially Fairvest, like all good landlords, is really the capital provider here. And it's a lot of capital. The expected cumulative capex by FY27 would be 4.8 billion rand. By 2030, it could be as high as 24.3 billion rand. That's a lot. Interestingly, Fibre Time's technology partner is Nokia. And I was quite surprised to see in one of the pictures that they have battery backup there, because we all know that Nokia batteries last forever. It's amazing to think back to a time where everyone had a Nokia 3310, and now absolutely nobody you know has a Nokia phone. Technology does change rather quickly. But back to the returns, the net yield on capital deployed here, 15.1% on an ungeared basis. That is really, really good, because traditional property ownership, like retail malls, you would expect to see high single digits in terms of yield. Here, you're sitting in mid-teens. And what that means is that you can gear this up spectacularly by throwing debt at it, because the cost of debt is probably low double digits at most, sometimes high single digits, depending on the company in question. Certainly the big REITs can get debt at that sort of rate. So normally they have to go and buy a property on a very similar yield to their cost of debt. In this case, the yield is like almost double the cost of debt. So that creates some very juicy outcomes for geared returns. Interesting stuff here from Fairvest. And I'm not surprised to see the timing of this investor presentation, because if they are going to really get going on this and accelerate it and put debt against it, then they need the market to understand what the game plan is here and why they are doing it. It does seem rather interesting. Another point, by the way, that goes beyond just the financial returns is it gives them a lot of data on township residents. And of course, that's helpful when a big part of your business model is to have township adjacent properties. And then last one, this is news from last week, but I'm just catching up on what's been happening on the JSE while I've been dealing with all these other issues. That is Pepkor. Here, I am a shareholder. I bought shares a couple of months ago based on the underlying business and the upside optionality of the bank they're building. It's a very nice surprise to see even more momentum in their fintech business than I expected. The news that came out last week was that they are combining their Flash business with shop-to-shop to create the so-called FintechCo. I'm sure it'll have a better name down the line. It'll be a 21.3 billion rand business, so they'll certainly have some marketing budget. And Pepkor will have 57.1% in that merged entity. That number is calculated based on the value of Flash, which is around 10.6 billion rand, and a cash subscription by Pepkor for new shares in FintechCo to the value of 1.57 billion rand. As I pointed out on social media at the time of the deal, FintechCo would therefore be worth more than Truworths or the Foschini Group, which is quite amazing. You do have to be a little bit cautious here, because obviously this is a director's valuation of these private companies, whereas Truworths and the Foschini Group are publicly listed companies where we've got price discovery in the market every day. But still, the point is made, this is a big business that Pepkor is sitting on here. And with plans afoot to separately list it down the line, investors may well be able to get their hands on FintechCo directly. Now, what will this new fintech company represent? Well, the fintech ecosystem is about as complicated as you'll ever see anything in your life, really. But they will have extensive participation across the value chain linked to the informal markets. I think that's the key point to keep in mind. And this aligns very well with Pepkor's value-focused strategy. In terms of financials, we only have very outdated full-year numbers to work with. So September 2025 for Flash, June 2025 for shop-to-shop. That's now over a year old. But the difference in growth rates is staggering, with shop-to-shop having achieved a 3-year revenue compound annual growth rate, or CAGR, of 28% versus just 9% at Flash. In terms of profit after tax, Flash achieved 488 million rand, shop-to-shop 385 million rand. So pretty extraordinary stuff here. The one concern that has come up in the market, though, apart from relative valuations, which is always something that people will talk about, is that CEO Peter Erasmus, so this is the CEO of Pepkor, also has a stake in shop-to-shop that predates his appointment at Pepkor. Now, obviously, this does create a conflict of interest issue. It's not actually a related party deal if you go and apply the JSE rules, but the board still did the right thing by getting Erasmus to recluse himself from all the deliberations at board level. My view on this? Well, look, conflicts of interest always need to be carefully managed, but I would be a lot more worried if this looked like an odd deal or if a huge amount of cash was changing hands. But in practice, actually, strategically, this deal makes a lot of sense. It's in line with everything we've been hearing from Pepkor. And on top of that, it's really a merger. So this is a paper transaction. We're putting two things together based on what the companies involved and the directors involved are saying that they think it's worth. There's only a relatively small amount of cash changing hands, and it's a cash subscription for new shares. So it's going into this entity as opposed to being taken off the table. So that gives me a lot more comfort. Where you would be very concerned about a conflict of interest would be things like a strategically weird transaction and lots of cash being paid for shares to the person who is conflicted. That would be the big red flag in my books. But it's always good to be aware of these conflicts of interest and to at least think them through. That's it for this episode. Thank you for listening, and I look forward to bringing you the next one.